It is a disappointment, a kind of a surprise here that may throw some confusion into what's going on with the Fed. Negative 23,000 jobs. There have been people who've been forecasting that might happen sometime soon. Ian Lingen over at BMO turns out to be right today. The unemployment rate, though, drops to 4.1%, and I imagine what we're seeing there is another decline in the labor force. We'll take a look at that in just a second. Change in private payrolls, 30,000, and also the two-month net revision, 103,000 taken away. So what we're looking at is a labor market that is much weaker, at least on the hiring side. The change in private payrolls, as I mentioned, 30,000. Change in manufacturing, 5,000. Average hourly earnings up only 0.1%, so no inflation pressure there. Puts the year-over-year rate at 3.2%. Hours worked at 34.3. That's the same as it was in June. And the underemployment rate, 7.9%. The labor force participation rate does tick down to 61.4% from 61.5. So I'll take a look at the underlying numbers and get back to you in just a second on
Mike, thank you, buddy. You can guess what's happening in financial markets. Let's just start with the headline. There's a lot to figure out here, but for the headline, negative 23,000. The low estimate in our survey was 40. Positive. The median was 80. That's a big downside surprise. So in the bond market, let's start there. 2s, 10s and 30s. You look across the yield curve, you'll notice yields dropping quite aggressively at the front end of the curve as people reduce at least near-term expectations for Fed action, with 2s back down to, let's call it 416. In response to that, equities pick up on the S&P, on the Nasdaq, the Russell, with some outperformance around the small caps off the back of this, up by 0.75%. Lisa, just to work through the data and Mike will get to the details, it's a downside surprise on the headline number. You've got that quirk in a participation rate again. So you've got unemployment falling back from 4.2 to 4.1. We were looking for that to remain steady and unchanged at 4.2%. And then wages coming in softer than expected. Make sense of this puzzle this morning if you can.
No, thanks. I mean, right? I think that the only way that some people will try to explain this, first, I think that there will be a cohort of people who say it's a random number generator because ultimately it says more about the overarching dynamics of the input of available workers versus the demand on one side. To me, the thing that sticks out is 4.1% unemployment rate. That it ticked down to the lowest level going back to June of 2025, and it raises this question: is it just that people are dropping out of the force? Well, it looks like actually the number of underemployed went down, or at least the percentage. So this, to me, looks kind of like the productivity report yesterday, which speaks to a robust market that is not inflationary. Again, this goes to this question of, are we seeing what people are hoping for, which is increased productivity, more disinflation, but a solid economy?
We're in the process of digesting this data. This is the first move. We always say it, not necessarily the right move. A bit into the front end of the curve, a bit into bonds across the curve, but you see the bigger move at the front end, just dropping by 7 basis points on 2s. Equities responding positively to this as well. Mike, there's an obvious question when you look at data like that, whether it's the headline read, what it's happening with unemployment. Am I seeing the consequences of a supply story or a demand story or both, Mike? What do you see in the data?
Well, I hate to say this. I hate to use this word because everybody hates it, but seasonals. There was a decline of 50,000 jobs in local government education in July. Now, usually those people would tend to fall off the payrolls in May or June. And so I think what we're seeing here is a sort of a distortion in the overall numbers. If you add that 50,000 in, it would be a low 20,000 jobs or so created, but much better than what it looks like now. And when you look at the underlying categories, what you're seeing is slower job growth. So you're taking away probably from the demand side. The construction jobs were up 22,000, which you'd expect given the way construction is going these days. But a low hire in manufacturing and a whole loss of jobs, 19,000 in the retail business. And then in terms of leisure and hospitality, 40,000 jobs lost after 43,000 jobs lost in June. And we don't know exactly, but that may have a lot to do with the timing of the World Cup and people who were hired earlier in April and May to work on that. So it's not as bad on the top line as it appears, but it isn't great news either way.